The question is the 7 rules for successful real estate investing. And I've taken that to mean investing as an investor in a passive deal, right? So when you're out there trying to raise money or you're looking for deals to invest in, this is what you should be looking for. So the 2 sections are to look at the sponsor and at the deal level. So on the sponsor level, there are 4 things to really look at. First of all, be sure to read everything that the sponsor has done online, right? Read everything. Look at all their videos, listen to all their podcasts, read everything, get to know them as best as you possibly can. The second thing for the sponsor perspective is make sure, this is just a personal view, right, based on my experience, Nick, but make sure that they have multi-cycle experience. If you're looking at a sponsor that has only got 10 years or less, then they've never seen a downturn. So you've got to be really cautious of that sponsor. They're going to learn there's a higher chance that they will learn hard lessons during a downturn than somebody who's been through a downturn. So I like to see multi-cycle experience in sponsors. The third thing from the sponsor perspective is fee structure and alignment of interest. You want to be absolutely certain that your sponsor or the person you're investing in is in the same boat as you, that they benefit if you benefit, and that they feel pain if you feel pain. So you want to be sure that they have a good co-invest that isn't made up out of fees that they take out before you on day one. It's got to be real money. They have to have real money in it. And I'm going to give you a little trick, actually, that is something that I've developed that you can use that will really help you compare sponsors against the other. And this is a sophisticated idea, Nick, so bear with me. There are 2 types of internal rate of return that a sponsor will tell you. They'll tell you that the IRR on this project is, let's call it 15%. Well, the question that you must ask, and that they must tell you, per securities laws, even though I'm not a lawyer, right? So check with your lawyer. It's my CYA. But they have to tell you what the investor level IRR is. So be sure to ask them also what's the project level IRR. And the difference between those 2, the ratio between the difference of those 2, project level IRR and the investor level IRR, is how much is the sponsor taking out, right? How much are they taking out of the deal? And that ratio, so let's say it's the project level is 20% and the investor level is 15%, then the difference is 5%. So you divide that 5% into project level, and that gives you a 25% variance, right? It's 25%. That 25%, that ratio, is exactly how much the sponsor's taking out of the deal, and that includes fees. That's everything. That's soup to nuts, right? That's what they're taking out. And if you run that calculation, it's a real simple calculation, right? Like E equals MC squared, right? If you run that calculation on every deal that you see, you will see that the variation can be anything from high single digits to low 30%. So if you see that variation is in the 30s, that is a sponsor who's taking out a bucket load of money. If you see it in the high single digits, that's a sponsor whose interests are more closely aligned with yours. The other thing that you want to look for in a sponsor are you got to get into the contracts. You want to, again, that, could go through a whole list I've got a list of 10 of these things, right, separately. But one that jumps to mind in the contracts is your rights and responsibilities. And the key thing you want to see in there, your voting rights and your ability to connect with other investors. If the sponsor is disallowing you, prohibiting you from knowing who other investors are, that's a red flag, right? If things go wrong, you might want to call a vote. And if you don't know how to reach the other investors, how do you call a vote, right? The second thing is the deal level. The deal level analytics. So I talked about the sponsor, 4 things that you look for in a sponsor. On the deal level, I've got 4 different things, right? So that's actually 8 rules. On the deal level, the beautiful thing about investing in a crowdfunded deal is you don't have to do the work yourself. By the time you get into a deal, the sponsor has gone through most of the heavy lifting, right? They've found they've located an asset, they've put together a business plan, they've done a feasibility study, they've conducted a contract negotiations, and they've done due diligence, and they've probably made a formal commitment. So the beauty of investing in a crowdfunded deal is you don't have to do any of that work. All you have to do is to check the sponsor's work product. That's a lot easier than having to do it yourself, right? Like marking somebody else's work. So that's number 1. Make sure you check their work product. 2, under the deal level of 4, make sure that you understand how key concepts work. And by that, I mean key financial concepts. And there are 8 key financial concepts that you must understand. And I'm not talking textbook or going on to Google and looking it up or YouTube and looking it up, right? It really depends on how much money you want to lose, right? How well you know these concepts. The best way to know these concepts is to learn them from the sponsor perspective. And the 8 financial keys are net operating income, cap rate, returns, and all the different kinds of returns and how they're used in the industry, the terms, equity multiple, the IRR, one of the hardest ones, the preferred return, what is the promote, and leverage or debt. So those are the 8 financial keys about which you should become an expert if you're going to invest in online deals. The third aspect of the deal level, or the third rule, I should say, under the deal level subheading, is, I already said it actually. So learn these key concepts, these key financial concepts from a sponsor perspective, from somebody who's been through it themselves and who has experience, right? Because that way, then you'll be really, you will then be able to read through the lines of the pitch decks that sponsors give you. Remember, a pitch deck is a sales document, right? They are going to be putting it into the best possible light. But if they are good sponsor and sophisticated with experience, there will be signals in that document that will clue you in to what they really mean, right? And the best way to learn that is to learn from the sponsor perspective what these terms mean, right? So that was the third point. The fourth is, so now I'm at 8, right? 4 for sponsor and deal level, now 4. So that's a total of 8. The due diligence. So you, like I said, you don't need to do due diligence on a deal yourself. That's one of the great benefits of investing in syndicated deals. But you do need to verify the sponsor's work product and their ability to actually develop and execute on the business plan. And not just that, but also their ability, their internal capabilities to complete and effectively manage the process. And there are, let's see, how many have we got here? 1, 2, 3, 4, 5, 6, 7, 8, 9 different aspects of the due diligence that you should familiarize yourself with and be sure to drill down on when you look at a deal. And I'll just rattle those off now, Nick, for you. First of all, the general high-level project description, right? Where did that come from? Legal review. How has the sponsor looked at all the legal documents, including title and environmental reports, etc.? Site analysis. And that dovetails into the regulatory analysis. What are the zoning laws? Do they have the rights to do what they want? Are there any permits that are required? How far along in the process are there? Are they, et cetera, et cetera? That can kill a deal, right? If you get that wrong. As dull as it seems, that's one of the most important. Market analysis, right? You want to know what the supply and demand is in the area around a deal. Verify cost assumptions. Make sure that the sponsor has done a good job of that, right? How have they built their pro forma? How many bids have they had for each line item, and why did they select the subs that they did? Make sure they have a good, robust pro forma and stress test it. See if you can get a hold of it, and then change some of the numbers. Or if they won't give it to you, have them change the numbers and see what it does to the end result. And if it's counterintuitive to what you would expect, they have an error in their pro forma, right? So help them get that right. Finally, actually the penultimate thing. So just two things left, Nick. One is what is their assessment on how long it's going to take, and how did they get to that assessment? Why do they think it's going to take as long as it did? And then the final thing, you want to be absolutely sure that they have enough money to do this deal, not just your $50,000 or $100,000 or $10,000 or $500, right? Whatever it is that you're investing in a deal, but do they have enough? And that means, do they have their bank debt lined up? And do they have good reason to believe that they're going to get the equity that they need and be able to execute on the plan?